While Indian stocks wobbled into the new quarter and the rupee slid past 95 to the dollar, one important number barely moved at all. India's 10-year government bond yield sat quietly around 6.76%, almost exactly where it had been the day before. In a week full of noise, that stillness is easy to ignore. But the 10-year yield is arguably the most important number in the whole economy, and when it stays calm while everything around it shakes, that calm is not boring, it is a message. This is the story of what that number really is, and why its quiet can tell you more than the market's loud days. Here is why this one yield matters so much. The 10-year government bond yield is, in effect, the price of money for the whole country. It sits underneath the value of every stock, because a company's future profits are worth less today when that discount rate is higher. It shapes the cost of home loans and business borrowing, and it reflects what investors expect about inflation and interest rates for years ahead. So the bond market sits upstream of almost everything. When that upstream number is steady, even as equities and the currency get choppy, it is quietly telling you that the deepest anchor in the system has not moved. And that changes how you read the noise on the surface. So let us put the numbers side by side. The Reserve Bank of India's policy repo rate is 5.25%, and at its June meeting, the central bank held that rate steady with a neutral stance. The 10-year government bond yield sits above it, near 6.76%, easing from around 6.70 the previous session. That gap between the overnight policy rate and the 10-year is normal, because lending for 10 years carries more uncertainty than lending overnight. What matters is that both are relatively contained. The bond market is pricing steady policy, even as equity investors fret over global risk and the rupee feels foreign selling. That is a divergence worth understanding. Now the mechanism, and it explains the divergence. A 10-year yield is, roughly, the market's average expectation of where short-term interest rates will sit over the next 10 years, plus a cushion for uncertainty called the term premium. Short-term rates are set by the central bank, so when the 10-year yield holds steady near 6.76%, the bond market is quietly saying it expects the Reserve Bank to keep policy roughly where it is, without sharp moves in either direction. Equities, meanwhile, respond to faster, noisier forces, foreign investors pulling money out, the rupee under pressure, global headlines. Those can rattle stocks day to day without changing the long-run rate view. That is how you get wobbling equities sitting on top of a calm bond market. The surface is choppy, but the anchor beneath it is holding, and the anchor is what sets the discount rate under every asset. Here is what that means in practice. As long as the 10-year yield stays contained, the discount rate under equity valuations is not rising, and that quietly cushions stock prices even on ugly days. It is one reason a market can absorb foreign selling without falling apart. But the same logic runs in reverse, and that is the part worth respecting. If that yield were to jump sharply, say on an inflation scare or a funding shock, the cushion would thin, and the pressure that equities shrugged off could suddenly bite. Historically, stress in the bond market tends to show up before stress in stocks, because rates sit upstream. So the calm 10-year is doing real work right now, holding the anchor while the surface churns. The number to respect is not today's level, it is how fast that level can change. So add the 10-year yield to the small set of numbers you actually watch. Not because it predicts the next move, it does not. It is a lens, not a signal. What it tells you is which environment you are standing in, one where the rate anchor is calm and shocks get absorbed, or one where it is straining and shocks get amplified. Right now, with the yield near 6.76% while stocks and the rupee wobble, the anchor is holding, and that context matters more than any single loud day. The forward question worth sitting with is this: what happens the next time the rupee is under pressure and that calm 10-year yield finally starts to move?